All right, so now let's learn how to process transactions. So in this double entry accounting method, as I said, we're going to identify the transactions, analyze the transactions, record transactions, and then post the entries into the general ledger book. So here is a transaction. So we identified first as the company receives $30,000 cash from a investor, okay, and that investor just become the owner or one of the owners of the company. And then we analyze using this basic accounting equation, assets equals to liabilities plus equity. And then we will see the cash got an increase and equity got an increase in this transaction. And then we do the recording. So we use this general entry, okay, this account. So cash got a debit because it increases, that's a assets. Capital increases, that's a credit, and it's an equity. And then we gotta post each individual items on a general ledger. So under the cash ledger, we put a debit of $30,000 for this activity. And on the ledger of capital account, we put $30,000 on the credit side. And the second transaction here is identified as a company pays $2,500 cash for supplies. So if you analyze in this accounting equation, cash got reduced, supplies increase, there's nothing changed to liabilities and equity. And then you'll record the transaction in the journal, and you will see supplies got a debit and the cash got a credit, and supplies decrease, supplies increase as assets and the cash decrease as assets. So that's why they are recorded in these positions. And then you put the supplies in the general ledger, and you see supplies got a debit of 2,500, and a cash this time got two items. One is from the first activity, the second is from this activity, the new one. So that basically makes your cash reduced by 2,500, or that's a credit being recorded here. So those are the 4 steps you need to take for each transaction. And then we move down to the next one. The company purchased equipment for cash. The company pays $26,000, and you will see the equipment increased by $26,000. The cash got reduced by $26,000. Liabilities and the equity does not change at all. And equipment is marked as item 167, and there's a debit because as an asset, equipment increases, and the cash got a decrease, so that's a credit. And the last step is to put the number in the ledger. So for equipment, that's the ledger for equipment. That's a debit 26,000, and for cash, now it combines 1, 2, 3 items, and the last item is a $26,000 credit because your cash got reduced due to the purchase of equipment. Now, this fourth transaction, the company purchases $7,100 of supplies on credit from suppliers. This time, no cash got involved. When you buy the stuff, you do not pay in cash. You will pay in the later period, but as long as the expenses is recognized, there should be a recording. So what happens is your supplies get increased by $7,100, and on the liabilities, you have more bills to pay, and you have accounts payable increased by $7,100. That is your obligation, which makes you deliver this amount of money in the future. And when you do the third step recording, the supplies got an increase by $3,100. That's a debit for assets, and accounts payable got a increase because it's a liability. So when liability increase, that's a credit. So the supplies in the general ledger of supplies, there are 2 items now. The one item is from second activity. The next item is from the fourth activity. And then you also have accounts payable, which is recorded as a new general ledger. And right here, it has only one activity. And that one activity makes your account payable increase by 7,100 because of the liability, that's a credit. All right. And here we have another transaction. So the company provides consulting services and you immediately get paid in cash. So what happens here is there is a revenue being earned and a cash increase. So the revenue belongs to owner's equity, and that's a positive effect on equity. So when owner's equity from revenue increases, so that's a credit. And when cash increases as assets, that's a debit. And now if you look at the general ledger for cash, you have three activities before, and the fourth activity is this one. So the cash got an increase, so that's a debit of $4,200. And if you look at the revenue ledger, this is the consulting revenue. So the only thing being recorded here is from this activity, number 5, and there is a credit being injected there. Number 6, payment of expense in cash. The company pays $1,000 cash for December rent. So your cash got reduced, it will be recorded as a credit, and the expense is being paid. So expense is like a negative equity. So when expense increase, your equity got reduced. So so that's why the expenses, when they increase, it should be a debit. So if you look at the general ledger, this is the very first activity recorded for ledger of expense. That's a debit of 1,000. And for cash, that's a new activity. You just spend another $1,000, so that's a credit, okay? So that's a decrease of assets. It should be recorded as credit. The next one is the payment of expense in cash. The company just paid $700 cash for employee salary. So cash got reduced by 700, salary expense got reduced by it's actually incurred a expense of 700. So expense, as I mentioned earlier, just like your rent expense, it is a negative equity. When it increases, that's a debit. And when cash is an asset, when it increases, that's a when cash decrease, I'm sorry, that's a credit. So you will see that salary expense is being recorded as a debit, and the cash here got a credit. So basically, you spend cash to pay salary. Number 8, you just provide some services and earn $1,900, and this $1,900 is from a consulting service and also your facility rentals. So in this analysis, you will see accounts receivable increase. Why is account receivable is not cash? Because the whole thing is paid on credit. It's not paid by cash, which means after you deliver the service, after you rent your place to a tenant, you do not get paid cash right away. You will have a bill issued to them, and they will pay you in the future. Right now, on your balance sheet, you will have a $1,900 account receivable, which will be collected to cash in a later period, maybe 1 month or 3 months later. And account receivable is an asset. So when assets increase, that's a debit. So you just happen to have an account receivable now, and that is a debit due to its assets feature. And when you earn revenue, and revenues, no matter what kind of revenue, is a plus on owner's equity, so that is a credit. Okay, so you have 2 revenues, so that means you need to build into 2 ledgers. One is consulting revenue, which already has recorded transaction number 5. Now this is transaction number 8. That's a new number you put in there. And for rental revenue, that's the only one we have so far. All right. Number 9, the company just receives a $1,900 from the client billed in transaction 8. So basically, the bill is being paid off. So they finally give money to you in cash. So what happens is you'll receive $1,900 cash, but that bill you give it to them or the borrowing notes will be disappeared. So it should be destroyed. It should be destroyed or just teared off because they don't owe you money anymore. So account receivable is gone now, but the cash increases by the same amount. You will see assets have no net change, so the liabilities and equities would have no change at all. In the record, you will see cash got an increase, so that's a debit, and account receivable decrease, that's a credit. These are both assets. And then you put each item into the right place for the ledger recording. So cash, right here, you have a debit of 1,900, okay, cash increase. And for account receivable, you have a credit because it just decreased. So for account receivable, it was built up in transaction 8. Now it is paid off in transaction 9. So what's the overall balance so far? Of course, that's 0. So in transaction 10, there's a partial payment of accounts payable. So when you buy things and decide to pay your vendors later, right now you have account payable, that's a liabilities. And then sometime in the future, you finally decide you want to pay the bill, and you're gonna pay $900 for part of the account payable. So in this analysis, you will see assets, the cash got reduced by 900, and account payable, it also got reduced by 900 because you have a reduction of the bills to pay. So if the liability got reduced, then that should be recorded as a debit. And once again, when cash as assets got reduced, that'll be recorded as a credit. So in the ledger, you will see account payable. It used to be 9,100, which was built up in transaction 4. Now part of it is paid off in amount of $900. And for cash, there is a $900 credit, so your cash got further reduced by that amount. Number 11, withdrawal of cash by owner. So withdrawal is like a negative equity, and that basically make a cash disappear from the company's financial account. So you will see a negative 200 deduction in equity. You will see a negative 200 change on assets for cash. And then since the equity deduction, that's a debit, and when cash reduced, that's a credit. And this is your first general ledger for withdrawals. So right here it is 200 debit, all right, and that's another cash activities together with all the others. So that's another 200 deduction of your cash. That's a credit. All right, so right here is a new activity, the receipt of cash for future services. So this basically says the company receives $3,000 cash in advance for providing the consulting services to a customer. Well, you receive $3,000, but you have not done the service yet. You just get paid now before you actually do the job. So you have the obligation to do the job later. And today, you have that obligation, well, that should be called a liability. So for any unearned revenue, that's a liability. On this equation, you will see cash got an increase just because you get the money, And you also have liabilities increase because you have a future fulfillment of these contract. And in the record, you will see cash got a debit because it increases, and an unearned revenue as a liability, it also increases as a credit. Number 13, pay cash for future insurance coverage. So you just pay $2,400 cash for a 24-month insurance policy, basically $100 per month. Well, you will see that this is a prepaid, and anything that is called prepaid should be an asset because you have already paid the bill for the future period. You don't have to worry about it for a long time. That's a plus for your business. And on the asset side, you will see cash got reduced by $2,400, and the prepaid insurance got increased by $2,400. And there's nothing changed in liabilities and equity because it's just mainly a transfer of assets. And on this record, you will see a preferred insurance got a debit. When an asset increase, that's a debit. And cash got reduced by 24. That's just another entry here. But for a prepaid insurance, this is the first record. Number 14, the company purchased supplies for cash. Well, this is an easy one to understand. So supplies increase, cash decrease. So they are both assets. None of the liability or equity changes. And supplies got an increase as a 120 debit. Cash got a decrease as 120 credit. And this will go to the according journal. Number 15, payment of expense in cash. Well, expense is a negative equity, as I have addressed a long time ago. So you have a $305 cash deduction due to the payment, and also your equity got reduced by $305. So the cash got reduced as the credit, and expenses is incurred, so that's a debit. So this is the ledger for expense, and on the ledger of cash, you just have another input, which is a $305 credit or a deduction of cash. Number 16, payment of expense in cash. This time the company pays a $700 cash as a salary, so that's a salary expense. Cash goes down, salary expense goes down, and you will see expense again is a negative equity. So when it got incurred, that is a debit, and a cash got a credit because cash got reduced. So for salary expense, there's just another entry here, and for cash, that's just another entry. And here we have the general ledger for all items. You see that assets, liabilities, and equity. So assets include cash, which is your most involved item. And you see all these activities have the impact on your cash. And for account receivables, that's another asset. Supplies, another assets, prepaid insurance and equipment. And you need to use the debit and credit. You combine the balance on both sides, you will see the balance, remaining balance there. For example, for account receivable, 1900 here, 1900 here, the remaining balance 0. For supplies, you have a group of numbers here, no number here, and then the balance is a summation of the three numbers. Okay, and then you would have a total number which is recorded here as 42,395. And for liabilities, the only two things being mentioned for liabilities are accounts payable, which involve 2 transactions, and earned consulting revenue, which involves only 1 transaction. and the total would give you $9,200 credit. And for equity, so you have an owner's equity, owner's withdrawal, consulting services, rental revenue, expenses, so on and so forth. And that together gives you $33,195. And if you combine liabilities and equity altogether, this will be equal to your total assets. So this is the last part. We just finished the general ledger.